In this example, we're determining our standard direct materials cost based on information that we have about our production. So based on our information about the direct materials required for a product, the percent that evaporates during manufacturing, we have a liquid product that evaporates during manufacturing, and then that we have a discount on purchases for our product. So we want to figure out what the standard cost is based on what is required for production, the evaporation, and our discount. So we'll have our total direct materials per bag at 60 pounds. We have remaining after evaporation. So that's 0.75 because 25% evaporates. We have 0.75 available after evaporation. So the total standard quantity that we need to factor in for that evaporation is 80 pounds. Our price per pound is $2.50. So the total purchase price per bag is 80 pounds times $2.50 or $200. We then take our purchase discount of 2%. So 200 times 2% is $4. So the standard direct material cost per bag for production is 200 minus 4, $196. And that is the standard cost we would use for our direct materials and our variance analysis. Now we're going to look at another variance analysis problem. In this problem, our information is given to us a little bit differently than in the first example. So we have to back into some of our information. So we have a master budget or a static budget result and our actual results. And we're going to create our flexible budget down here. So we're going to bring information for our actual results. So we have actual sales volume was 4,000. Our actual sales revenue was $390. Our total variable cost per unit is $70 per unit. So that's our total. So we would take 4,000 units times $70 per unit. So that's our total variable cost. Then what we have is that the variable selling costs or variable marketing costs are 10% of sales. So our marketing costs are our sales times 10%. Now we need to figure our manufacturing costs, which the problem has not given us this information, but we know what our variable costs are and what our total variable costs are. So we take our total variable costs minus our marketing variable costs to figure that in. So our contribution margin is our sales minus our total variable costs. Now we need to look at our fixed costs. So we have information about our fixed costs. We're told that our fixed manufacturing costs are $50,000 and that we have fixed marketing costs that we had an increase of 4,000. So our total marketing costs, our budgeted marketing costs were $36,000. So what that tells us is that our fixed costs were $50,000 and our marketing costs were $36,000 plus $4,000 for a total of $40,000. So our total fixed costs are $90,000, giving us an operating income of $20,000, which is also the operating income that the problem gave us we had. Now we want to build our master or our static budget. So what we budgeted for sales in units was 3,900 units. We have a budgeted sales price of $100 per unit. We have budgeted manufacturing costs of $50 per unit. And we have variable marketing costs of 10% of sales. So our total variable costs, $234,000. So our contribution margin is our sales minus our total variable costs for $156,000. Our manufacturing budget we have is $50,000 for fixed manufacturing and $36,000 for fixed marketing costs. So our static budget operating income is $70,000. Now we need to calculate what the flexible budget would be. So we know that the flexible budget and the actual results match in units. Then we need to calculate our flexible budget amounts at our static budget rate. So we have our flexible, our 4,000 units times our budgeted selling price of $100 per unit. And our manufacturing, so 4,000 units times variable manufacturing of $50 per unit. Our marketing costs are 10% of our sales costs. So our total variable costs in our flexible budget are $240,000. Contribution margin, sales minus total variable cost is $160,000. Now our fixed costs would match our static budget because of fixed costs within the relevant range, but they stay the same within the relevant range from our cost volume profit chapter. So our flexible budget operating income is $86,000. So now we would look at our variances between our actual results, the flexible budget amount, and our sales volume variance. So let's do the sales volume variance first. We have 100 favorable variance for number of units sold. We have a $10,000 favorable variance for sales revenues. We have a $5,000 unfavorable variance for manufacturing costs and a $1,000 unfavorable variance for our marketing expenses, our variable marketing expenses. So we have a $6,000 total variance between our total variable cost. We, however, have a $4,000 positive variance in contribution margin. We have zero variance in any of our fixed costs, and we have overall a $4,000 favorable sales volume variance budget. Now, when we look at the flexible to actual, our sales are zero, our units are zero variance. We have a $10,000 unfavorable variance in sales revenues. We have a $41,000 unfavorable variance in our costs. We spent $41,000 more than we intended in our manufacturing variable costs, but we saved $1,000 in our marketing costs. Overall, we had a $40,000 overrun in total variable costs, and our contribution margin was $50,000 less than our flexible budget. So we had a $50,000 unfavorable. Our fixed manufacturing costs were exactly the same. There's zero variance there. We have a $4,000 unfavorable variance in our marketing costs. We spent $4,000 more than we intended. So we have a $4,000 unfavorable variance in our total fixed costs. And all told, we have a $54,000 unfavorable variance in our operating income. Our total static budget variance is the flexible budget variance plus our sales volume variance. So our static budget variance is unfavorable $50,000 variance. Now the other questions, there are no other questions on this problem.